We cashed out our RRSPs in February of 2025. So what I want to do in this video, everyone, is really try to tell you, was the RRSP really worth it? Our journey of not managing our own RRSP, just going the traditional route of having a financial advisor, managing, going through mutual funds, and then the transition of us managing it ourselves. What are the results? How did they do? We closed them out. Why did we close them out? And then more importantly, what are some tips and recommendations for you, or our opinions here, my opinion, in case you're trying to decide, should I manage the RRSP myself? Should I even bother with the RRSP? What should I put in the RRSP? These are basically things I wish I would have known at 18 when we started the RRSP to begin with. So let's get going. Before we continue, I'd like to thank the sponsor of today's video, Global X Canada. And in case you didn't know, they recently launched the Global X Enhanced Gold Producer Equity Covered Call ETF, which is an ETF that invests in gold producer companies and its enhanced income via a 25% leverage. So essentially, if we look at the holdings, it holds 125% of their existing GLCC ETF, which holds gold producers, and they're writing covered calls on a portion of the portfolio, which generates that consistent monthly income that income investors are looking for. So we also know that gold producers benefit with rising gold prices. So check it out, everyone. I highly recommend you check out their website. GLCL recently launched. The first distribution has been declared at 16.1 cents a month per share. So again, you will benefit from rising gold prices with this ETF, and you can check it out on their website. And if ever you want access or some yield of physical gold itself, they also have the HGY ETF, the Global X Gold Yield ETF, where they're writing covered calls on a physical gold ETF to generate, as of June 17th, for example, here, a yield of about just under 5.5%. So make sure to check them out. If you're an income investor and are interested in having gold exposure, these could be great ETFs to add to your portfolio. So I don't want to spend too much time on this. If you've watched my channel and you watch my monthly portfolio unveils, you already know about this. But in case you didn't, essentially, we're Canadian non-residents, and as Canadian non-residents, you could cash out your RSPs whenever you want. You just have to pay the universal withholding tax of 25%. So if you're a Canadian resident, whatever comes out of your RSP, which is probably going to be a RIF, by then it gets taxed as if it's regular income according to your regular income tax bracket. But when you're non-resident, it's a flat 25% withholding tax, which is not so bad. So we closed them in February of 2025, maybe, I don't know, 4 months ago now. And it's very easy to judge how it performed, because all you have to do is calculate how much you actually put in throughout your whole lifetime, right? And then what came out. So what has come out, or the value plus what has come out, right? So for us, it's easy. It's closed now. So it's simply how much did we put in total, and what is the total value when everything was sold. So 145K is what I contributed, and it was 315 when sold. Erica 166 when sold, 315, same thing. We had the exact same thing in there. So here you have the profit and the return, and then the profit and the return after the 25% withholding tax. So, about 200,000 together, and over 100K each, which is not bad. You have the percentages there. In terms of how we managed and what we did, well, when we started, obviously we went the traditional route. We had a financial advisor, we had mutual funds, they come to your house. I was with Investors Group, and Erica was with Great West Life. But the experience was pretty much the same thing. It's all the same thing, right? They come to your house, they ask you a million questions. You want low risk, medium, high risk, all that crap. You go into mutual funds, they choose it for you. We know the deal, and I think you guys already know my opinion about that. But we started, once we started learning about investing, we managed it ourselves. We transferred it to self-directed accounts. If you want to see the actual history, I started tracking all the history of what we did in the RSPs starting in May of 2022. You could actually download this sheet, by the way, on our website, passiveincomeinvesting.ca. Go to free tools and resources, and it will be the very first download. And one of the tabs at the bottom will be the RRSP and Lira tracker. The RRSP and Lira tracker. So you could check it out. Now, I don't want to scare you because we did a lot of moves and a lot of stuff. We were obviously learning, and new funds came out when we were self-directing. So eventually we got it down to just a one ETF, QDTE, which is a NASDAQ 100 0DT covered call ETF. But either way, we sold everything and it closed on February of 2025. So what are the major lessons learned? What did I wish I knew? And what is our recommendation if you're thinking about the RSP, managing yourself? What do I put in here, etc.? So the first thing I will tell you, everyone, is that it was absolutely worth it. Absolutely worth it. Especially, if you're making over 50K a year in Canada, 60K a year, it makes complete sense because we know that RSP contributions are deductible, right? Deductible dollar for dollar, so you can get a tax refund. There's tax savings. I'm not going to dig deep into there, but what I will tell you is it's absolutely worth it. Yes, when money comes out, it gets taxed like regular income, but you have to remember that if you're starting your RSP at 18 or 20 or whatever, and you're not planning on touching it till 60, 65, all that growth within the RSP account is tax free. So you could literally be investing a couple $100 a month, total 100K, and maybe after 10, 20, 30 years, it could be $1 million, $2 million. It all grows tax free in there. It's very important to understand that. So it is absolutely worth it. So that's the first piece of advice I will give you. I know a lot of people don't like the RSP because when you take it out, you get taxed, but it's absolutely worth it. Not only you will get those tax refunds, especially if you put money in there consistently and a lot of money. Obviously there's limits, there's limitations, and everything grows tax free. Another tip I will give you is really, really important. Make it automatic, because some people wait last minute to do the TFSA contributions in February or the first 60 days of the new year. Do an automatic monthly payment so you don't have to think about it. I don't care if it's $50, $100, $300. Make it automatic. A really nice percentage that I figured out is try to contribute at least 10%, 5 to 10% of your after-tax salary. So if you're making like $4,000 a month clean, try to contribute at least $300-400 a month. It's a good amount where most likely you'll get a tax refund. So go with that rule. I think it makes sense. Obviously, you want to do as much as possible without going over the limit. Now, some people have the pension with the work; those are going away. But sometimes if you put in an amount, they'll match it, and then if you leave the company, it goes into a LIRA, which kind of works the same way as an RSP. I strongly recommend you do that. It's like free money. Some people, some companies let you manage. You could pick the mutual funds at least. Maybe you got to be with Sun Life or you got to be with Manulife, but you're able to choose your investments. A little bit more on that later. That's even better when you could choose. But if there's any matching situation with an RSP or a LIRA at work, I would say definitely go for it. And if I would have to tell you my number one recommendation or piece of advice here, and of course this is not financial advice, I'm not a financial advisor, this is just my personal opinion, like I'm talking to myself if I was 18 again. Manage it yourself. Manage it yourself. Self-directed account, manage it yourself. It's never been easier. It's never been easier to choose the funds and ETFs. We'll get into that later. It could be very, very simple. If there's one thing you got to take from this video, is manage it yourself. Now, if you take that step, okay, you believe in the RSP, you're contributing to it regularly, it's helping your tax situation. What do you do? What do you put in there for the long term? What do you put? There's a million things, right? Do you go with Canadian stocks or US stocks and bonds or one stock? Do you take a risk and go with a single stock? So what I would have done if I knew what I know now, I'm going to tell you exactly what I would have done. Okay, so my number one piece of advice, if you're managing your own RRSP or LIRA, your wife's RRSP or LIRA, whatever it is, keep it as simple as possible. All you need is one or two funds max. Keep it simple and stick with US stocks. That's it. That's all you need. Get the overall best stock market in the world with the best companies in the world, which happens to be United States. Just get the overall US market. And the two best vehicles to do that, if you want one vehicle, it would be the S&P 500. Okay, if you want to buy it in Canadian dollars, you're buying it in Canadian dollars, you could just get VFV. I know that some people say, oh, you might as well convert your money to get VOO, the Vanguard S&P 500 on the US stock market. I'm not going to dig deep into that, but either way, I'm going to give you some different S&P and NASDAQ 100 options, but keep it simple, everyone. It's the easiest thing. The S&P 500 best companies in the US, automatically diversified. You don't have to manage it, babysit it, very, very low fee. VFV is the most popular one. Okay, if you want, all you do is get that, you put it on drip, and that's it. The last 40 years, it's been growing about 11% annual return. It'll just compound like crazy. Get out of here, Vanguard. It'll compound like crazy. Stick with US equities. My opinion, you don't need to get the whole world. You don't need bonds. You don't need any of that stuff. Just get the S&P 500. Oh, but it's only US. What if with the US, it's the best companies in the world that have international revenues from all over the place. They always outperform Canadian stocks over time, European stocks over time, emerging markets over time. I would just get an overall US market option. So there's VFV, and another great index is a NASDAQ 100 index. These are my two favorite indexes, very, very popular. So VFV is the Canadian Vanguard S&P 500, and QQC is the Canadian NASDAQ 100. So it's like the QQQ of Canada, and VFV is the VOO. VFV is the VOO of Canada. BMO also has a NASDAQ 100 one. By the way, ZNQ, QQC, whatever it is, VFV for your S&P 500. I don't care if it's 50-50. 50-50 is good if you want to keep it simple. 75-25. Of course, NASDAQ 100 a little bit more risky because it has more technology stocks, but the NASDAQ 100 has been doing better than the S&P 500 because there's more tech stocks. Whatever it is, stick with US equities, the overall market, and make it simple. Keep it simple so it's very easy to manage, very, very hands off. I will give you a few more options. Of course, if you love income investing like me, if you want to keep it simple, there's USCL and QQCL, okay? The NASDAQ 100 covered call ETF with 25% leverage, the S&P 500 covered call ETF with 25% leverage. You'll get a big monthly income. You turn the drip on, you forget about it. You'll get similar performance to just buying the index funds thanks to that 25% leverage. And the good news is that when you do retire later on, you never have to sell anything. You could just stop the drip and start taking out the dividends, or living off the dividends, if you will. There's a big advantage with that, but they have higher fees. They're not guaranteed. They're going to perform similar to just holding the S&P 500, to just holding the NASDAQ 100, but it's not guaranteed. Maybe they'll outperform, but there is leverage here. But this is personally what I would do. Personally, I would go with a US based, overall US with covered calls and 25% leverage, but that's because I'm an income investor. If you don't really care about that, you don't know what covered calls are yet or whatever, you could always stick with an index fund. But now I'm going to give you a third option, which I think is even more powerful than both of these. Okay, so you have just a regular index fund which covers the entire US market. Again, no babysitting, no rebalancing. Forget about that. It's super, super easy. You buy these, you put them on drip, and you keep buying more shares. That's it. You do that for 40 years, I'm telling you, you'll be a millionaire for sure. If you don't feel like getting the cover call one, the income one, because you don't really need the income, or you're going to switch from the growth one to the income one later, I'll give you a third option, which I think is very overlooked now. It's a bit of a newer fund. It's literally the Global X S&P 500 enhanced and the NASDAQ 100 enhanced. 25% leverage, no covered calls, guys. 25% leverage, no covered calls, which means USSL is literally VFV with 25% leverage. In fact, they have USSX, which is the S&P 5. They have their own VFV. This is Global X's VFV. But if you just change that X to an L, you'll get USSX with 25% leverage. And that's why when you look at the holdings of USSL, it's basically the Global X S&P 500 Index ETF, which is USSX, 125% exposure. Same concept for QQQL. Okay, QQQX is just the Nasdaq 100. QQQL is the Nasdaq 100 with 25% leverage. Now, what does leverage mean? It means that they're borrowing 25% of the fund's net asset value. They're borrowing that amount. So it's not a lot of leverage. It's very light leverage. That's why they say, typically, they say light leverage in here. It's magnified. So obviously there's more leverage. There's going to be, 25% leverage. There's going to be 25% more risk, more volatility. But this is the RRSP, guys. You're not going to be touching it for years and years and years. So it doesn't matter. So this is a powerful option, which is very, very simple. If you believe the overall American stock market's going to go up over time and you're not going to touch it for years and years and years, why not get a little bit of leverage? This is leverage that's integrated in the fund. It's not you borrowing the money, it's Global X borrowing it. They're getting much better interest rates than you are and I can. Interest rates are really, really low. And I'm not saying you're going to get 25% more performance, but for example, if we look at USSL, the stock market has done really well in the last year, right? USSL, you see that the 1 year performance is 15.70. If we look at USSX, the S&P without the leverage, the 1 year performance is 13.99. So you see that you're getting better performance with the 25% leverage version. I think over time, and if this S&P goes up over time and the Nasdaq goes up over time, of course USSL and QQQL is going to outperform, is going to do better than just the Nasdaq 100, right? Just the S&P 500. So that's just my personal opinion here. Again, not financial advice or anything like that, but these are some very powerful ETFs that are to consider for an RRSP, because you're going to get a little bit of enhancement, but they're still hands off. Right, they're still hands off. They're still very easy. You're still investing in the Nasdaq 100, the S&P 500, and again, there's no right or wrong. Of maybe you just want to go with USSL and that's it. To just get that could be fine too, right? Have you ever encountered someone who's lost money over the long term investing in the S&P 500? 0 people, right? So this is just a cool option, guys. And again, manage it yourself. Keep it really, really simple. Make it automatic and don't ignore the RRSP. It's very, very powerful. Yes, when money comes out, it's taxed at your regular income, but you'll be in a much lower tax bracket. And I suggest you go to taxtips.ca, you choose your province, and you'll see that, let's say most people in retirement, I guess, are not making 93,000, not declaring 93,000. The income that comes out is going to be taxed at 30%. Right? If you're making up to 57, it's at 24%. So it's still worth it, because remember, the compounding interest throughout those decades is all tax free. So you could literally turn 100 grand into $1 million or 2 million. Yes, when money comes out, you pay taxes on it, but trust me, it's still very, very worth it. It's never been easier in the history of our lifetime to manage your own RRSP. You don't need a financial advisor. You can manage it yourself. Keep it really simple. Stick with US equities. The easiest way to do that is with the US indexes, which in my opinion, the two best ones are the S&P and the Nasdaq. If it makes you feel comfortable going with the Vanguard and the Invesco, go for it. If you really like the income like me, you're just going to put the drip on. There's USCL, there's QQCL, there's HYLD, there's plenty of other ones. And if you don't want to cover calls, now you have 25% leverage growth versions, which are very, very attractive for the long term, in my opinion. So give me a thumbs up, guys. I hope you appreciated this video. The whole point was really to give you some recommendations and my opinion in case you are thinking about RRSP, managing yourself, what you put in it. This is the easiest, simplest way, which I personally believe, my opinion here, you cannot go wrong, and it's very, very well worth it. See you next time.